Video game stocks can be some of the most appealing in the market because it's relatively easy to understand, hey, if you like these video games, the games the company makes, why not buy the stock and benefit from the growth and sales that they're generating? But it's a little bit more complicated than that. And right now, a lot of video game stocks are very expensive. There's been a ton of consolidation in the industry, and there's a lot of changes going on in where video games are being played. Console sales are not growing the way that they used to. You've got your niche consoles with Nintendo. You have Sony running away with the next generation console. A lot of games are moving to mobile, and a studio is either attached to one of those platforms where they can benefit from the distribution and integration with those platforms, or they're an independent studio that has to just struggle to make great games that people want to buy. Electronic Arts, one of the most iconic game studios in the world, but is it a good investment right now? They just came out with second quarter results, and I think it really shows the struggle that the company has from a strategic perspective and why this is not necessarily a growth business that's worth the value that is trading for in the market today. That's what I'm going to dig into. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start this with a couple of valuation metrics to just put this up front. Electronic Arts stock trades for 32 times trailing earnings and 20 times forward earnings. Analysts are expecting forward 2-year growth, so growth over the next 2 years, to compound at 4%. So price to earnings multiple is 30, growth rate 4%. What do the second quarter numbers tell us? These are some of the highlights from fiscal first quarter 2025, so second quarter calendar year. And they grew net bookings by double digits over year in Madden NFL. They like to always put the best numbers up front here, so that's no surprise. Live service trailing 12-month revenue, $5.3 billion. This is where a lot of the revenue has transitioned over the last few years. And $7.1 billion in total trailing 12 months net booking. $1.9 billion in trailing 12 months free cash flow. So again, you look at the market cap of about almost $40 billion. The $1.9 billion free cash flow number on a trailing 12-month basis is going to put that multiple enterprise value to free cash flow at about 20. So not the worst multiple, but it's not a great multiple if your sales are slowing. This is the quarterly numbers, so $1.3 billion in revenue in the most recent quarter. Full game sales now not accounting for very much in sales at all. Live services are dominating the company's business now. Trailing 12 months revenue, though, this is going to be a little bit more of an indicator of how the business is doing. $7.1 billion, down 7% year over year. Even those live services numbers down 4% year over year. You can see right here that even the quarterly numbers down 7% year over year. So none of these things are trending in the right direction. Bookings by platform. Again, these numbers are very similar to the revenue numbers. These are bookings by platform. So gives you an idea of how much of the business is mobile. A fairly small percentage is mobile. That was down 5%. PC and other, a little bit bigger portion of the business, but that was down 13%. And console games down 25% or 5% on a trailing 12-month basis. So each one of these segments is declining. Are conditions going to get better this year? At least that is the indication. Now, there are a lot of holiday sales that happen, but you can see that management is expecting $7.1 to $7.5 billion worth of revenue. Again, that's going to put that price to sales multiple at about 4x. Earnings per share, $3.34 to $4 per share. At best, that would put the company's price to earnings multiple at about 38. So this is what I'm talking about. Very expensive stock, but a stock that's not really growing. In fact, it's shrinking. Margins are solid. So this is a very profitable company. But again, what are you paying for the profitability that you're getting and the growth that you're getting in the business? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, these aren't new trends. The decline in revenue or relatively tepid growth for Electronic Arts is not something new. And that's because these console changes and where people are playing games, what kind of games they're finding value in, has been changing over really the last 10 to 15 years. So if you pull back and look at these revenue numbers, you can see that revenue increased during the pandemic a bit, but that was in line with when they made a couple of big acquisitions, Codemasters for $1.2 billion, Glue Mobile for $2.4 billion, Playdemic for $1.4 billion. So that started to impact revenue in 2021 and then also into 2022. Now, over the past 12 months, we're starting to see that revenue start to turn around and go south. So the best days, in a lot of ways, for the gaming industry is really behind us. I think one of the things that really confused things was the acquisition of Activision Blizzard by Microsoft. That was a much more of a strategic acquisition. That was not necessarily a financial acquisition, and we've seen that in their numbers. Activision not necessarily doing all that well from a studio standpoint. The core Xbox business is not growing significantly. They reported that in their recent quarterly report. Even Sony not doing all that well with its consoles because the console has now become a niche way to play games. You can also play games on your PC. You can play games on your mobile phone, on your tablet. And the way that you're reaching customers with all of those is very different as well. The rise of game engines like Unity, like the Unreal Engine, has taken a lot of the power away from these big studios who used to develop all that technology themselves. So that makes the game building process more accessible to more developers. And that means that there can be more games and more supply into the market. There's also new ways to reach customers with advertising, direct response advertising, where you see an advertisement on your mobile phone, you click on it, you make a purchase. That's going to be a way to get customers, not the same kind of brand advertising that we have with a lot of the EA games, Formula One, NFL. Those are much more brand level games. And that's why we're not seeing growth in these segments, because that's not where the growth is in the gaming market overall. I think a much more attractive place in the market is going to be something like these game makers. Now, Unity has its own struggles. And so that's one of the reasons that I have not purchased that stock or not long that stock. And I've covered that before on this channel, that they have their own monetization challenges. But that's really where the power is in the gaming industry today, is being the tool or the platform being used to create games that end up on PC, on smartphones, on mobile, and even in some cases on consoles. I think you either want to be there or you want to be one of the big platform companies like a Microsoft or like Sony or even like Nintendo. But Electronic Arts is kind of out in the cold on its own. It has to be able to work with all of these other platform companies, but they're each going to take a piece of the pie. They're not going to get the same kind of integration with all of these other platforms. The advantage is they're not going to be exclusive to anybody, but that doesn't mean that they're going to grow the business overall. And I think we see that with the numbers. You're seeing declines across the board, across all their segments. And despite the fact that this is a positive free cash flow company, it's not a valuation that I would be buying today. If we were, say, looking at a company that was trading for a price to earnings multiple or price to free cash flow multiple of 10 times, 11 times, that would be much more attractive to overlook some of the strategic challenges that Electronic Arts faces, but that's not where we are today. This is a relatively expensive stock, nearly 40 times the company's expected fiscal 2025 earnings, and that is just too much to pay for Electronic Arts today. But what do you think of the results and the company's valuation? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.